Okay, in this video I'm just going to be going through a range of revision questions from the start of Chapter 5, just to really make sure that your language is on track when you're answering some of these questions. So first things first, explain how real GDP growth above 3% can have both positive influences on living standards and negative influences on living standards. First thing I'd be saying in this question is that economic growth that is too high, generally above 4 to 5%, is likely to be environmentally unsustainable. So it can lead to excessive depletion of our natural resources or the environment. That can have negative impacts on non-material living standards because our quality of life or enjoyment of life is impaired because of our natural environment being impaired. So, for example, excessive growth in production might lead to pollution of waterways or destruction of native bushland, which reduces the enjoyment of these natural assets by members of society. We could also talk about climate change there or destruction of forests. However, economic growth above 3% is likely to have a favourable impact on material living standards, given that a greater volume of production generally needs more resources, so circular flow type understanding, which leads to higher incomes for their productive input. To the extent that income flows to households in like wages and dividends or salaries, it improves their access to goods and services. So try and make that link then that living standards is all about access to goods and services, material living standards, which boost the average material living standards of society. Define the government's goal of strong and sustainable economic growth and discuss one impact of material living standards of failing to meet this goal. So again, when you're getting questions on material living standards, you want to be making links to purchasing power. So strong and sustainable economic growth refers to the fastest rate of growth in real GDP that is strong enough to promote jobs without being too strong that it creates external, environmental or inflation pressures. So that's one mark. Failure to achieve a strong rate of economic growth can have a negative impact on employment and incomes. Growth in real GDP of 1% is generally associated with unlikely to create additional jobs, generally results in rates of unemployment increasing, partly as our population grows, and therefore lower average incomes. This reduces material living standards because the average Australian will be able to purchase fewer goods and services, and real GDP per capita is likely to fall. So making really strong links there to material living standards, purchasing power of consumers. Explain why a rate of economic growth above 4% may not cause inflation. Again, a rate of economic growth above 4% might not cause inflation if we're able to boost our aggregate supply or our productive capacity by the same rate, so by 4%. That way we've got an increase in supply to meet that additional demand. So if we're able to invest in things like technology, ways to improve productivity by boosting the skills of the workplace, immigration, keeping up to date with modern work practices and new technology, then we can reduce our production costs, increase productivity, and expand our aggregate supply so that it meets that extra demand and we don't experience inflationary pressures. So why does Australia aim for a rate of economic growth above 3%? And two reasons why below 3% growth are insufficient. So we aim for 3% because this is the rate which we're able to boost our productive capacity. Growth above 3% can cause inflationary and environmental problems, so when it's too high, and that can hurt our living standards. Having said that, we need to grow by at least 3% to cater for our growing or rising population, so that we don't experience higher unemployment. And we also have to account for the fact that productivity is increasing, so unless we increase our output, that's going to lead to more unemployment, as we need less workers to do the same level of, or the same jobs, the same level of output, because each worker can work more productively. So we need to grow at 3% to ensure that while productivity grows, that doesn't cause more unemployment. Outline what could happen to long-term economic growth if growth rates are above 5 to 6% in the short term. We could experience a decrease in economic growth in the long term. If fast growth is due to excessive spending, this will reduce the amount of savings available. So again, that can hurt our ability to invest in the future. So if we grow really fast because of excessive consumption, that reduces our ability to invest and therefore reduces our ability to boost our productive capacity in the long term. Likewise, excessive growth can cause inflation, and that reduces our international competitiveness. Or the other thing you could talk about is excessive growth reduces the quality of the environment, so it can lead to environmental pressures. So all those things, a lack of savings, high inflation, and the environmental pressures, which is essentially your goal, or the things we're trying to achieve in the goal, are all bad things associated with growing too fast, and why it can lead to a trade-off for our long-term growth. Two reasons why China is able to sustain a faster rate of growth than Australia. One, their productivity is increasing, and that's due to improvements in technology. So they're able to meet added demand without excessive inflation. They've also improved the quality of their labour or entrepreneurial resources. Again, that's helped to boost productivity and therefore allow them to meet demand without excessive inflationary pressures. Other options, things like better policies and the fact that they were working below their productive capacity in the past. Okay, this question here, really important question. I'm asking you to discuss the benefits of strong rates of economic growth for Australia's real incomes, the unemployment rate, and the provision of essential government services. So, if economic growth exceeds the rate of growth in productivity, it will generally boost the derived demand for labour. So increased production of goods and services will help to boost employment. This helps also to generate revenue for the government in the form of things like GST, income taxes and state government taxes, which means that increased government revenue and then allows the government to spend more on essential services. So they can spend that money on funding for hospitals, schools and infrastructure, which is as a result of the increase in employment and increased taxation revenue. The increased taxation revenue can also be used to reduce incidents of poverty, homelessness, drug addiction, gambling, smoking, etc., which all helps to boost the quality of our living standards. So, and when you're linking it to employment and income, growth in production typically means there's been a growth in incomes due to the extra demand for factors of production. Higher incomes help to boost our ability to afford goods and services, so boost our purchasing power, and it also helps to reduce the rate of unemployment because there's more demand for workers as a result of increased production. Governments wish to reduce unemployment because it has negative implications for society and our living standards through crime, social unrest, and less purchasing power. So you want to make three really clear links to the fact that incomes go up because of higher employment, unemployment goes down, and the government collects more tax, which they can use to provide essential services. So, really quickly just going through these because we've talked about them in the other videos, but we want to grow at least 3%, and that's because our labour force continues to grow every year, so we need to increase production to meet the increase in our labour force, otherwise unemployment will go up. Secondly, productivity growth. Increased productivity is good, but it means we need less workers. So unless we can grow our production to meet that increase in productivity, it's going to lead to more unemployment. So we need to grow at least 3% to match our productivity growth, so it doesn't reduce employment. And lastly, it's important for our non-material living standards to grow at 3% because it can lead to more unemployment, which hurts crime and social isolation. If there's high levels of unemployment, increased poverty, and when the government can improve our non-material living standards because the government's got more money to provide essential services. So the benefits for our living standards, again, we've talked about this in the past. Boosting real incomes, increased production leads to more employment and therefore higher real incomes. That boosts purchasing power and can also have benefits for non-material living standards. Reduces unemployment, assuming that growth exceeds productivity growth because production increases the derived demand for labour. And lastly, higher growth in employment boosts taxation revenue, GST, income tax, company tax. They can use that money to provide essential services, which then helps to boost both material living standards and non-material living standards through reducing issues like some of these, like poverty and drug addiction and domestic violence, etc. You also need to be aware of the relationships between some of the economic goals. So again, we talked about this question in the last one, but if it's just a 2-mark question about how strong rates of economic growth will impact unemployment, just talk about the positives. So strong economic growth, generally above 4%, so define what strong economic growth actually means, is likely to reduce levels of unemployment. This is because strong economic growth means the value or level of production is increased, which increases the derived demand for labour, which would help to reduce unemployment levels. If it's a longer question, so a 4-mark question, to analyse the relationship between economic growth and employment, okay, it's really important that you have a balanced approach and that you explain the relationship both ways. So the impact that growth has on employment, and then as back the impact that employment has on growth. It's also important that you recognise that it's not all positive as well. So starting with economic growth, if economic growth increases, it typically are expected to increase employment because more goods and services are being produced, which means we need more resources such as labour as inputs in the production process. This should boost the derived demand for labour and increase employment. However, it's important to recognise that this is not always the case. It could be because of increased automation or increased productivity growth. So I would just quickly state that while economic growth generally increases employment, it's not always the case. And from the other direction, for your other 2 marks, an increase in employment is likely to increase economic growth because average household incomes will increase. Greater employment means more people earning factor incomes rather than transfer incomes. They can use this money and then you can link it to consumption. Higher incomes leads to higher consumption, which helps to boost aggregate demand, and that should flow on to increased production, boosting real GDP. So really summarising really quickly, the benefits of growth for employment, high levels of production leads to increased demand for labour. Not always the case though because of automation, increased labour productivity, or people just might work longer hours. In terms of the other way, benefits of growth for employment, Higher levels of demand lead to increased production, which boosts the derived demand for labour. I've done the same one twice. Please ignore this second slide. They're exactly the same as the first one. Two factors that might explain why positive rates of economic growth might not reduce the rate of unemployment. So economic growth may not reduce the rate of unemployment if the rate of productivity growth is at relatively high levels, such that any increase in production can just be obtained with the same amount of resources. This is referred to as jobless growth and generally occurs when productivity growth exceeds the rate of economic growth. It can also occur due to automation, reducing the need to hire as many workers, or an increase in the population. So if the participation rate increases, even though overall employment will probably increase, it may not reduce unemployment because more people are in the workforce. So growth may increase because we have a lot of immigration. That boosts overall employment, but not necessarily reducing unemployment because more people are in the labour force. Lastly, annual and annualised growth, something we talked about when we did Chapter 4. So what is the difference between annualised rates of growth and the annual rate of economic growth? Basically, the annualised growth rate calculates a figure for growth in a particular quarter and then multiplies this value by 4 to work out the growth for the year. So if growth is 1% in the March quarter, then growth for the year is at 4%, whereas the annual rate of economic growth calculates year-on-year growth by measuring the value of production in a particular quarter and comparing it to the same quarter last year. So for example, if they would compare March 2015 to March 2014 to see how much production has increased throughout the whole year. Describe the different ways to interpret GDP statistics, focusing on quarterly, annual and annualised rates of growth. So GDP statistics can be calculated on a quarterly basis, which measures whether its growth has increased compared to the level of production in the 3 months previous. This figure can be multiplied by 4 to give an indication of the annualised rate of growth, or the rate of growth that would occur for the year if we continue to the rate of growth that occurred in that quarter. And then there's annual growth, which compares growth from 3 quarters to the same 3 quarters in the previous year. So they're the 3 ways essentially we measure growth: quarterly, annualised, and annual. You need to be able to articulate how those are all measured, with annual growth comparing production in a particular quarter to the same quarter last year, whereas quarterly growth takes it for the growth for the quarter and then times that by 4. There's also 2 other terms that you may not have heard of. Growth can be figures can be seasonally adjusted, which means they take out the impact of certain seasons. So, for example, they take out the impact of the Christmas period so that it more accurately reflects whether overall production has increased, taking away those seasonal trends. Is one way we look at growth as well. And lastly, explain how it is possible for Australia to record positive annual growth in real GDP when there are negative rates of economic growth for 2 quarters in that year. What that basically means is that the rate of economic growth in the other 2 quarters must be high enough to counteract the negative growth in the other 2 quarters. So, for example, if there was negative growth of 1% in the March and June quarters, it would require growth of over 2% combined in the other 2 quarters to still have positive annual growth. And when annualised growth rates are negative for a particular quarter, how do we still get annual growth rates that are positive? Well, annualised growth rates is calculated by calculating growth for a quarter and multiplying it by 4. This may be negative because we had 1 quarter of negative growth rates while still achieving positive growth rates in the other at 3 quarters, which allow for positive annual growth rates. So the annualised growth rate may be negative because growth was negative for a quarter, then we multiplied by 4. When we look at the year as a whole, production increased in the over that yearly period, despite the fact we had 1 negative quarter. Thank you.